Ladies and gentlemen, good morning. Welcome to the teleconference for the BIS quarterly review. I'm Alice. And now hand over to Jill Ford from the BIS. Please go ahead.
Good morning, everybody, and thank you for joining us. I'm Jill Ford, the Head of Communications, and I'm particularly pleased to welcome you here today because it's the first time we're holding an on-the-record media conference about the BIS quarterly review. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyun Song Shin, Economic Advisor and Head of Research, along with the authors of the quarterly review's special features. Before we begin, I'd like to reiterate that only comments from Mr. Borio and Mr. Shin are on the record, and all author comments are off the record, not for quoting or attribution. The conference will be recorded and the on-the-record sessions published on the website later today. So as a result, we'll start with questions on the overview and then follow by questions on the features. Thank you. So the quarterly review and press release and remarks embargo lifts today at 1 p.m. Central Eastern Standard Time. The data behind the graphs and the press release are also now live on the website. We'll start by giving some very brief introductory remarks and then open the floor to questions. And as I said, overview questions first, please. To get into the question queue, you need to dial the star key and then the number 1. So we have some questions, I think, probably coming afterwards, but if we can please start with opening remarks to Claudio. Thank you.
Good morning, and thanks for joining us. This quarterly review examines financial market activity from mid-June to early September. Over that period, financial markets recovered from the acute stress seen during the lockdown phase of the pandemic. Monetary and fiscal policy provided critical support for the rallying risky asset prices, and investor sentiment improved in response to more upbeat economic indicators. The strong increase in risky asset prices has raised the question of a possible disconnect between financial markets and the real economy. It is never easy to read financial markets, but based on a broad set of indicators, it is hard not to see a certain amount of daylight between risky asset prices on the one hand and economic prospects on the other. Still, the recent market jitters suggest that investors are growing more sensitive to the implications that the current environment has for elevated valuations. While the sectoral dispersion of equity valuations appears broadly in line with pandemic-induced expected longer-term changes in demand patterns, valuations are generally on the high side. The daylight is also visible in corporate bond markets, where spreads have narrowed to historically relatively compressed levels despite the deterioration in credit quality. During the past 3 months, the US dollar materially depreciated against other advanced economy currencies, particularly the euro, as the rapid fall in US interest rates eroded the yield advantage of dollar assets. The euro was supported by signs of more political and fiscal cohesion in the euro area. Overall, emerging market economy currencies remained range-bound on the back of global investors' lukewarm appetite for local currency assets. It is noteworthy that accommodative monetary policy in emerging markets helped push down yields on their sovereign debt. This is quite a departure from previous crises, when central banks would often hike interest rates to avoid currency meltdowns. I would also draw your attention to 2 interesting boxes in the overview. One analyzes more closely equity valuations. The other explores why equity investors have been negative towards banks, even though regulatory reforms ensure that they entered the pandemic well positioned to absorb losses.
Thank you very much. And then we go over to Hyun.
Yes, thank you, Jill. Let me just follow up on Claudio's comments, just by describing in very broad terms the 4 other pieces that we have in the quarterly review. These 4 pieces give a slightly longer-term perspective on economic developments in specific sectors, aspects or regions. And although the ultimate trajectory of financial markets will depend on the still uncertain course of the pandemic and its economic impact, the sectoral reallocations will certainly affect the real economy, and now is the right time to give some thought to them. So, as you saw in the press release, there are four other features. The first one looks at the cross-border linkages between banks and non-bank financial institutions, such as investment funds and central counterparties. And the authors discuss the possible vulnerabilities that could stem from such linkages and draw lessons from the turmoil that we saw back in March. The second feature looks at the Asia-Pacific commercial real estate market. And here the authors find that foreign investment vehicles dominate cross-border activity in these markets. And that, like portfolio flows, they are sensitive to global financial conditions, as well as to yield differentials between commercial real estate and benchmark bonds. The third feature looks at whether green bonds have significantly contributed to improving firms' carbon efficiency. And they also outline some desirable features of a possible green rating system for carbon emissions. And they look at how such a system could complement existing labeling systems. And finally, the last one is on corporate share buybacks. These buybacks have been very prevalent in the last few years. And this special feature looks at the relationship between share buybacks and corporate leverage, which is obviously a very important element in the current conjuncture as well. So let me stop there, Jill.
Thank you very much. We're now open to questions. So a reminder that we'll take questions on the overview first, and we'll come back on the features. Just to reiterate for anybody who may have dialed in late, the comments from Claudio Borio and Hyun Sun Shin are on the record, and any additional author comments will be on background only. So if you want to ask a question, please press the star key, and then the number 1. Okay, so we have a couple of questions in. So I'll start the first question from Mark Jones in Reuters.
Hi, good morning. Thanks for speaking to us today. Can everyone hear me? Is that all fine?
We can hear you perfectly, yes.
Excellent. Just a very quick question. You mentioned this kind of daylight between, the markets and perhaps the reality of COVID. Can you just kind of give us a feeling of how maybe concerning that is at this stage? And you kind of also go in to that idea of typically if we saw this kind of slump in the global economy, you'd see defaults rising a lot further. I think you say between 20 and 40%. And you also mentioned that zombie firm issue. So are these kind of measures from the government just delaying this? Are we still expecting to see that? Or are we, on the other end of it, is all this extra spending from the government's just potentially, obviously raising that prospect of potential debt crisis down the road? Thanks very much.
Well, there's a very large number of questions. Let me try and pick some of them, and if I leave some out, please come back. First of all, how concerning is this daylight between the state of financial markets and the real economy? Now, this kind of daylight is not uncommon, and although it's very difficult to read financial markets, it is something that, of course, is on policymakers' minds. How concerning is it? Well, this will depend very much on how the economy will evolve. We don't really know exactly how the tensions are going to be resolved. There is quite a lot of uncertainty about how the virus will evolve, and that will have big implications for financial markets and policy in general. Your second question, if I remember, is about the accommodation and the need for accommodation. Well, let me say, first of all, given that the economy is rather fragile, the withdrawal of accommodation is not for today, for tomorrow, or even for the day after tomorrow. But it's clear that at some point, accommodation will have to be phased out. I mean, we mentioned in the annual economic report that a more targeted approach at some point will be necessary, partly because obviously the ammunition which policymakers have is not infinite and in fact has become more limited. Now, exactly when that time will come, and that's clearly a country-specific decision. There is a delicate balance to be struck between, on the one hand, withdrawing it too early, which will obviously have short-term costs in terms of economic activity, and withdrawing it too late, which will mean that it will not favor the necessary structural adjustment in the economy. So this difficult balancing act is very much in policymakers' mind. One, of course, let's say that the more challenging phase of the crisis is ahead, and this goes back to your point about bankruptcies, because as we also said in the annual economic report, we are transitioning from the liquidity phase to the solvency phase. And in the solvency phase, the real challenge is to distinguish between viable and non-viable firms, that given the uncertainty about future demand patterns is not straightforward. And here comes the issue of the zombie firms, or better described as or defined as the persistently unprofitable firms. Clearly, their number, as our research shows, was increasing before the crisis, and that means that it's likely to be even larger, greater after the shock. But of course, the whole world is not a zombie firm. If you take, although they may account for a significant portion of, say, the stock market index, and they're likely to be bigger more in the context of smaller firms, they still account for a relatively small proportion of the overall capital stock. And therefore, some of them will indeed run into trouble when conditions normalize. The debt question is a big one, and this is very much a policy challenge going forward.
Thank you very much, Claudio. The next question comes from Catherine Bosley of Bloomberg.
Yes, hello, can you hear me?
We can hear you, yes. Thank you, Catherine.
Yes, I just wanted to follow up on basically my question is very much in this vein. You once said a few years ago that you were concerned because central banks and financial markets were locked in an embrace. And so I just wanted to get your thoughts on how your thinking in that on this issue has evolved, and how if you're saying that there is this daylight and it's hard to assess, then what's the upshot of this for policymakers down the road?
The relationship between central banks and markets is rather complex. On the one hand, markets give you information about the future outlook. On the other hand, central banks have a first-order impact on financial markets, and that is indeed their policy stimulus is transmitted to the real economy through financial markets. Now, therefore, you can see that there is feedback between what central banks do, how markets react, how markets behave, and what central banks do. And this is what I meant by the embrace. Central banks are fully aware of this. It obviously complicates policy. It is something that it's part and parcel of policy making. So going forward, and I'm absolutely sure that they will pay just as much attention to this as they have in the past.
Good morning, Arantxa. Can you hear us?
Yeah.
Great.
Can you hear me?
We can hear you as well.
Okay, thank you.
Thank you.
My question, you are mentioning in the report in the box regulatory reforms in the banking sector. Do you think that these reforms will push the consolidation in the European banks, for instance, and have you made any evaluation about the announcement of Bankia and CaixaBank of emerge? Thank you.
Well, thank you for that question. There are different aspects to it. The first one, which I think is important to underline, is that banks went into this crisis much better capitalized and more liquid than they had been in the past, largely as a result of the post-crisis international financial reforms that took place. And the Basel Committee, of course, played a key role there. Having said that, there are pockets or banking systems around the world that suffer from structural low profitability. And that's indeed an issue because profits are the first line of defense against losses. And unless you're profitable, your lending capacity is not as high as it would otherwise be. As a result of this, it's clear that low profitability calls for, in the systems where it is present, calls for structural changes that require a reduction in cost structures. And one possible way in which those costs can be cut is if you have consolidation. Now, consolidation is not a silver bullet, because sometimes it is not an end in itself. The end is to cut costs. The structural adjustment is important, and it requires action on the part both of the banks themselves, of management, and of policymakers trying to facilitate it by providing the right environment.
Thank you.
And the next question goes to Jack Schickler of MLEX Market Intelligence.
Hi, my question is on green bonds, in fact.
Okay, Jack, yeah. Please come in.
Your study on green bonds says that issuing companies' emissions actually increase a few years after they start their issue, and that the focus should be on the most polluting companies rather than the approach the EU has taken, which is to look at green companies rather than brown ones. Does this all suggest that green bond norms so far have got it horribly wrong?
Yes, hi, Jack. This is Hyun Shin speaking. The study has two parts. The first one is a fact-finding part where we look at how the footprint has varied depending on whether you have issued green bonds or not. And there, I think the evidence is fairly mixed. We would say the heart of the paper is more about what possible ways one could design a rating system that would apply to the firm as a whole rather than to specific projects. So I think it's this is the first of potentially a very rich set of investigations. So I don't think it's possible to draw any firm conclusions at the moment. And suffice to say that we'll be looking at this more closely.
Thank you very much. And I just remind everybody we're taking questions at the moment on the overview, and we'll return to the articles and the features afterwards. And a reminder that the features are the author's views, not the views of the BIS. So we have another question from Hugh Jones. Hugh Jones from Reuters, please.
Hi, sorry, I joined in late. I have a question on the articles. I'll wait.
Thank you, Hugh. So the next question goes to Paul Davies of the Wall Street Journal.
Well, so I could either do that or I could wait for a bit. It's up to you.
I think that's the cue to go to questions on the features. So I think Paul.
Shall I carry on then?
While we have you on the line, and
sure.
Then we'll bring back in your colleague.
So mine was on the first one about the cross-border links between banks and non-bank financial institutions. So the first one is, have you had any data? Have you seen anything about what's happened since the end of Q1 in terms of claims on non-bank financial institutions? And then the broader question I had is, do you have any kind of early assessments or thoughts on obviously the Fed and other central banks did a lot to address the dollar shortage that we saw. Do you have any thoughts on how the transmission of those efforts worked, whether they were quick and efficient enough? And then I guess more broadly in that what was going on then, was there any evidence that the draw on banks from non-bank financial institutions crowded out or affected the access to funding for non-financial institutions, so normal corporates?
Yes, hi, this is Yanishin again. The data that's behind this particular study is primarily the quantitative data. So these are quantities rather than prices, and we rely on the central banks to give us the data, and we assemble them. So the latest snapshot is very much until the end of March, which I think covers the most the acute period of the stress that we saw. The quantitative evidence that we have subsequently, I think, is more partial, but of course we're keeping a very close eye on it. I think on your question about the dollar liquidity facilities and the way that actually quelled the stress, I think we can look at other pieces of evidence and say that that was pretty effective, and that the announcement of the dollar swap lines and the repo facility, the FEMA facility, which is lending against treasury collateral, that was very effective in the early days, and we saw those spreads really coming down. But I think you also point to a very important aspect of what we saw in March, which was that there were many interconnected moving pieces. And I think what we can say fairly definitively is that unlike the Great Financial Crisis in 2008, which was primarily a banking sector-led crisis, what we saw this year was the market-based intermediation sector, or the non-bank financial intermediary sector, which saw the biggest stresses. So this is a combination of interconnected stresses that went through the bond market, the money markets, the FX market, and so on. Now, of course, the banking sector was not the epicenter of the crisis, but of course, they were affected, and one of the aspects that they were drawn into the stresses is exactly the point you mentioned, which was the lending to the non-financial corporates. Because the non-financial corporates were drawing down their credit lines, and so to the extent that the banks felt that they were limited in how much they can expand, this would have meant that other forms of lending would have been crowded out. So I think it's we still need to review the evidence and come to a more definitive view. But I think what this special feature does in this issue is to just point to how complicated and how multifaceted the events in March were.
I mean, and just to follow up on that, I mean, I guess one of the interesting things in this chapter is you kind of catalogue quite nicely some of the drains on bank liquidity from changes in liabilities towards central clearing counterparties from margin changes and so on. And obviously that is very there's nothing a bank can do to avoid that, whereas I guess there are kind of ways in which they can restrict even, credit facilities, revolver facilities, that sort of thing, to corporates. So I guess I was wondering whether there was any sense that, the CCP stuff had taken precedence over even corporate credit facilities that were in place in terms of them being capped off or anything like that. Was there any crowding out in that sense?
Yeah, I think this study is limited in two respects. One is that we're focused on the cross-border flows from banks to non-banks, and secondly, it's very aggregated, so that we don't we're not able to comment on the specific types of institutions. Now, if it's the CCPs or central counterparties that you're interested in, we have another publication which came out some time ago. In fact, by one of the same authors, Wenchan Huang and Elo Takats, which came out in the BIS bulletin. So I would just refer you to that bulletin piece, which goes into this in some detail. So, but that's a separate publication rather than the quarterly. Let me turn to Claudia, who wants to add something.
A couple of points. First of all, as you said, the changes in margin requirements affect banks in a number of ways. One is that some of those margins take the form of deposits or liabilities with the banks for third parties, but they're also, of course, the margins that banks themselves have to face, or either receive money or they pay money as a result of their position in the CCPs, in the derivatives markets. And of course, central banks are very large players, not least because they're also clearing members. The point about crowding out goes back to what I mentioned earlier in my presentation. Banks went into this crisis very well capitalized, to the point that, as you know, they've been regarded as part of the solution as opposed to part of the problem, as what happened during the great financial crisis that Hyun was pointing to. And they have been able to absorb the shock. They have been able to support the economy, and the drawing on credit lines is one example of that. Now, if you compare the evolution of credit during the great financial crisis, bank credit during the great financial crisis, and this one, you will see that it increased in this crisis, whereas it had fallen in the previous one, which is a clear sign of the shock absorber function that banks have played. Partly, of course, with the support of policymakers, prudential regulators who use the supervisory tools in a very flexible manner, and also governments that provide the guarantees. So that in this episode, the risk of crowding out in general, of course, was much less than during the previous crisis.
That's great. Thank you.
Thank you very much. And we'll go back now to Hugh Jones, who's been waiting patiently. So, Hugh, please come in with your question, and thank you for your forbearance.
Yeah, thanks very much. It's on to Claudia and Hyun, really. It's on the money market funds. Diplomatically, perhaps, the piece stopped short of mentioning possible reforms. I mean, can you elaborate a bit? What possible reforms could we see in money markets? I mean, I know the central bankers have been very keen to point out that they saved the lunch on money market funds by stepping in. It would have been carnage otherwise. Securities regulators are not quite so persuaded, maybe. Is there a consensus for specific reforms amongst securities and central bankers, regulators, to make changes to the sector?
First point, as you said, this crisis revealed a number of fault lines in the non-bank financial institutions sector, or if you like, market-based finance more broadly, and money market funds are an example of that. Clearly, it is not possible for central banks to have to intervene so massively in order to ensure that financial markets work smoothly. And of course, market-based finance is an issue there. Now, the perspective of central banks and the securities regulators is very, very different. Securities regulators look after investor protection. Central banks are concerned with financial stability. And it's clear that there can be tension between the two. Now, the Financial Stability Board is the place where that tension is supposed to be resolved. but it's not very easy. So when it comes to the money market funds specifically, we have seen reforms. Obviously, what happened suggests that they may not have been foolproof. And there is scope, and we have mentioned that in a number of publications, including in a paper that I wrote with some colleagues here, looking at the post-crisis international financial reforms. There is scope to adopt a more systemic approach to the regulation of this sector, which looks in particular to the impact that these institutions can have, intermediaries can have, on the financial system as a whole. Now, I could go into more detail, but I don't think that this is the right place to do so. You can look at some of that in the paper that I mentioned.
Yeah, this is Claudio, is it? Yeah. But what sort of specific reforms do you think? Did you think we're likely to see any specific reforms in the next year or two, or do you think this tension will continue to play out?
Look, I don't have a crystal ball. I can't say whether there will be reforms within the next year or next 2 years or so. What I can say is that definitely the question of whether it is possible to have a regulatory approach to these institutions and market finance more generally, which has a strong systemic focus, is going to be something that will be looked at very closely.
Okay.
Thank you very much. Thank you. And I think we have Mark Jones coming in again. So Mark Jones, and if there's anybody else wants to come in with a question, please press the star key and then number 1. Mark, do you have a question?
Hello there. Sorry, I was just on mute. Just a quick follow-up question on the green bonds box. And it's really simple. You put together this data on why green bonds haven't been particularly successful in reducing carbon intensities, like longer term at the firm level. How many companies did that kind of analysis cover, roughly?
Yeah, thanks, Mark. This is Hyun Shin. What we could do is, if you're interested in the detail, we could arrange a background briefing for you, with the authors. And I think that might, be perhaps a better way of taking this. I think the details are really quite interesting. This is probably the first, piece of this kind. And, there are many different questions that flow from this piece. And I think it would be actually useful. And thank you for your interest in this. I think Jill will follow up with Mark, and we can arrange
Mark, we can do
a more
that.
detailed background briefing.
Yeah, and if anybody else on this call wants to join that as well, just flag that, and we'll try and do that then later today. So if that's okay with you, Mark. So if there are any other final questions, a call for final questions, please press star and 1. So on the basis that I'm not sure that we have any other particular calls, thank you very much for your time today. Reminder that the embargo lifts at 1 p.m. And again, if there are any follow-up questions on the features, we're more than happy to take those questions as well from the team. So thank you very much again for your time, everybody. Thank you to the authors and to everybody who's involved in the communication today. And we will be talking again in, I think, December for the next quarterly review. Take care. Bye-bye.